Morning, everyone. Thank you, and welcome to our webinar. I'm just going to wait a few seconds to let everybody log in, so we'll get started shortly. So good morning, everyone, and thanks for joining us today. My name is Sue Talbot, and I'm a partner and portfolio manager here at Genis, and I will be moderating today's session. And with me today are three leaders in the Canadian impact investing space. We have Mari Matthews of Spring Activator, Adam Spence of Social Venture Connection, also known as SVX, and our own Mike Thiessen. Today, we're going to be embarking on a panel discussion, and we're going to talk about the current impact investing landscape in Canada. We're going to talk about three key trends that we see emerging in 2021 and how they will shape the future of impact investing in Canada. We're also going to add a link to each speaker's LinkedIn profile so you can connect with them after today's session. And while we're waiting for people to log in, let's just take care of a few housekeeping items. We're going to be conducting a Q&A session at the end after the speakers. So please type in your questions in the chat box to the right there. The chat will be private, so no other participants will see your questions. And we're going to be recording this session as well. And if you have any technical issues, please let us know through the chat as well, and we will try to get somebody to help you as well. I'd like to start off today by acknowledging the Indigenous people of all the lands that we are on today. While we meet today on a virtual platform, we would like to take a moment to acknowledge the importance of the land which we all call home. From coast to coast, we acknowledge the ancestral and unceded territory of all the Inuit, Métis, and First Nations people that call this nation home and who have taken care of this land. Canada is home to Indigenous people from across Turtle Island, and we are grateful to have the opportunity to meet and work on this territory. Before we bring in our panelists, I have a question for our audience, so we can get a feel of who's in the room with us. And we have our first poll question, and hopefully you'll see it come up to the right there. So it will be up in a moment. Okay, there it is. I hope everybody can see it there. So the question is, how would you describe your level of engagement in impact investing? And you can see the choices there. The choices are interested, but not yet active. Early engagement through a few investments. Actively building impact investing in my portfolio. And my portfolio focuses on impact alongside returns. And we also have an other category. So if you're going to choose other, please let us know in the chat what your other option is going to be. So it looks like we have 64% of our audience answering so far, and it looks like interested but not yet active seems to be the front runner. And we'll just wait a little bit longer here to get more answers in. So it looks like a resounding over 44% interested but not yet active. So that's great. Thank you, everybody, for participating in that. So I'm just going to quickly go to the chat to see if anybody's entered any other. Okay, so nobody has answered other. Okay, great. Thank you. Keeping up with trends in responsible investing is an increasingly difficult task in 2021. As responsible investors, we're subject to many different terms which represent a wide range of different sustainable styles. Before we get started, let's make sure we understand what encompasses impact investing. Impact investing goes one step further than simply divesting from fossil fuels and other harmful products and services. Impact investing is made with the intention to generate positive social and environmental impact along with a financial return. This is where you're doing more than simply just eliminating the bad investments. This is where you're actively seeking out the good investments. So you're using the positive screen, as they call it, and you're seeking to make that environmental or social impact. Impact investing is also measurable. In 2015, the United Nations developed 17 global goals known as the Sustainable Development Goals, or the SDGs. So these goals were designed to be a blueprint to achieve a better and more sustainable future for all. They also provide a great framework in which investors can map and address global challenges, things like climate change, inequality, health, and poverty, just to name a few. And the UN SDGs have been widely adopted as well as a way for impact investors to choose which areas they want to support and to measure the impact of their investments based on the specific targets of each goal. In a nutshell, impact investing allows you to invest in a way that's intentional, measurable, and impacts the world in a positive manner. What about the growth of impact investing? At home here in Canada, according to a RIA 2018 Trends report, impact investing assets grew an amazing 81% to $14.8 billion from 2015 to 2017. So that's a huge increase over this 2-year period. The 2018 RIA report also indicates that the growth of impact investing in Canada is likely to continue. Almost 90% of those surveyed expect moderate to high levels of growth in impact investing. And this aligns with a more recent report by GIN that shows that global impact investing grew by more than 70% over a 4-year period from 2015 to 2019. It's also no surprise that impact investing is particularly popular amongst millennials and Gen Xers. And according to a 2018 study by Fidelity Charity, 78% of millennials and 72% of Gen Xers indicated that they had made some form of impact investing. And this compares with only 30% of baby boomers and older generations. So this implies that impact investing will become more important as the younger generation grows amongst investors. And what is on the horizon for impact investing? Well, we can't ignore how the COVID-19 pandemic has impacted both the economy and society. It's created this perfect storm of environmental, social, and governance issues. And this has really driven the need for investors to take action. In turn, they're demanding that corporations operate in a positive manner towards the environment and society. Investors want to be on the right side of change and not on the wrong side. And these goals seem more important than ever today. We have identified three key trends that are gaining momentum in 2021 due to all these factors. And today, our experts will share their insights into why these trends are important and what may happen next. Those 3 trends are early stage impact investing, place-based impact investing, and climate action impact investing. So unfortunately, we're only limited to 3 people with video on this platform. So I am going to stop my video now, and I'm going to ask our speakers to turn theirs on. So here we go. Hi, Maury. So we'll start off with Maury Matthews of Spring Activator, who will discuss early stage impact investing. And this is where investors provide startup funding, and there are a number of really innovative projects in this space. So I will hand it over to Maury.
Thank you very much, Sume, and thank you to Genesis Capital for inviting me to speak here. I feel quite honored to be here with everyone today, and thanks to all the attendees for coming and having an interest in impact investing. You know, I don't profess to be an expert in many of the areas that we're going to speak about today, but what I do know and have quite a bit of experience is in the early stage impact investing ecosystem. So My name is Mari Matthews. I'm the director leading Spring Activator's investment pillar. I'm an entrepreneur, so I've built and exited a company in the past. And I've been working with Spring over the last few years to support early stage entrepreneurs seek investment and create opportunities as well for new impact investors to enter the space. So this might interest the audience that's here with us today, and I'll speak further to that. So Spring Activator, we're a company that exists to change the world through entrepreneurship. Early stage impact businesses are creating innovative solutions to tackle some of the globe's biggest problems. And I know that, Genis invests in SDG funds, ESG funds. I'm going to speak about the SDGs. But a lot of the work that we do with early stage impact businesses are those companies of tomorrow. And we feel that our role and our obligation is to catalyze the growth of these solutions, these innovative tech solutions in clean tech, med tech, health tech, food safety. We're seeing a lot in food safety, particularly post-pandemic or due to the pandemic, equality, diversity, circular economy. These businesses and these entrepreneurs are our future. Their success is so essential to reach our global sustainable targets. Many of these businesses are within the, kind of focus on all of the 17 UN SDGs, so the UN Sustainable Development Goals. So they are very impact, purpose-driven aligned businesses, but otherwise look, very similar to any of your typical startups that you hear about. These companies that are tackling these issues, they can't do it alone. And so what I would like to advocate for a little bit today too is just speak to how you might be able to get involved, and talk a bit about the work that we're doing, that Spring and SVX, and we're so privileged to partner with Genis Capital in tackling these issues. But knowing that they can't do it alone, they do need investment. And I think everyone's kind of heard of that, and we looked at the poll questions there. Investment is one of the ways that you can help support these businesses grow, but they also need resources. They need knowledge, they need industry expertise, they need mentorship and advisors. And, I would like to guess that many of you sitting here today have a lot of those. You've worked many years in a particular industry, or have built and perhaps sold companies yourself that can offer insights that are so valuable to helping these businesses reach their goals. So I just, that's a little bit about Spring and the work that we do. I'll speak to as we go. But really what we're focusing on is growing the amount of capital in that early stage space to allow for these companies to succeed. The companies tend to be, past that real true startup stage. They're in their growth phase. They're needing capital and resources for that growth stage. They are, for the most part, highly profitable companies or planning to be highly profitable companies. As I was mentioning, some of them are, more lifestyle businesses that are also important, pieces of the picture that are contributing a lot to the local economies, which I think Adam will be speaking to. But we would just love to get more individuals involved, and that's really the work that we at Spring are trying to accomplish. So I think that was about my first 5 to 7 minutes. I know there's so much more to talk about, and I look forward to having those answers come out in the Q&A or get into those discussions and answer any questions that you guys might have about early stage impact investing in the Q&A.
Great, thanks, Mari. Next.
Thank you. Would you like me to stay on, or should I just take my camera off and let Adam come on?
I think either works. Let's bring Adam up now. So next will be Adam Spence of SVX. Adam will discuss place-based impact investing, and place-based impact investing allows investors to target the neighborhoods, communities, and regions where they live. And I know a number of my clients have expressed the importance of finding ways to support their struggling local communities, and especially in light of what has happened in the past year. So I will hand it over to Adam now.
Wonderful. Thanks very much for the opportunity to speak. and just amazing to see the number of folks that are on this particular webinar and to be joined by great partners. So what I want to talk about is first, what is place-based impact investing? How does it work? Why it's important? And then what are some examples? So as was described, what place-based impact investing really is, it's the local deployment of impact capital. So the idea here is, as with impact investing, it's about generating financial return, but also delivering community benefit. So to particular neighborhoods, regions, or even ecosystems. So it could be at a provincial level, but think of it as essentially investing in your own backyard for a good purpose. And so that might be financing a local startup, a community-based project, or affordable housing organization. I think there's a real track record and history of this in Canada and the United States. There's a CDFI movement, billions of dollars dedicated, just $9 billion invested by the federal government alone this fall. There's community cooperatives, there's community bonds, community futures organizations, and there's a ton of momentum that is really following this particular approach to investing. So how does it work? Really, I think the primary tool is often through funds or cooperatives that are financing local organizations, projects, or enterprises, and investors would put capital into them. There certainly are cases of direct local investments in one's backyard, but a more common way to do it is through an intermediary. It would take place across a range of asset classes, and so could be a cash or cash equivalent investment, like a Vancity term deposit, where folks are investing locally in British Columbia enterprises and organizations. There's fixed income products. So anything from community bonds, like the Innovation Works community bond in London, or CSI in Toronto, or ZooShare. And there's community loan funds as well, St. John Community Loan Fund, Birch Capital, and we'll talk a bit about those. And then there's private equity, things like the Upper Canada Equity Fund in Prince Edward County, and then real assets. So folks like Vancity Community Investment Bank worked with Community Land Trust in Parkdale to be able to invest in that particular backyard, or Hamilton Community Foundations and others invested in Indwell, which is a housing provider in southwestern Ontario. So lots of different ways that you can do it and make these kinds of investments, again, that generate impact and return in your own backyard. Why is it important? So I think lots of reasons. One is place-based impact investing is seen as being more responsive to local community needs and better able to address social, environmental, and economic issues with greater efficiency. And so if you look at folks' understanding and ability to put capital in their own backyard and know the issues, be able to touch it and be connected to it. For example, there's House of Friendship in Kitchener-Waterloo, which was an opioids addiction facility and emergency shelter where local investors and local foundation understood the issue, understood the organization, were able to put capital in to be able to grow that facility. It's also a great way for folks, particularly that would be faced with economic barriers or challenges, to create jobs and greater investment. So community futures organizations, particularly in rural Canada, have been very effective at place-based impact investing and seen as a way to battle things like the exodus of young people or underinvestment. And as was said at the outset of this conversation, it's much more important now than ever before in the wake of COVID. And so there have been tremendously long-standing issues, from inequality to climate change to housing. The pandemic has had a tremendously negative impact on women, BIPOC communities, racialized individuals, newcomers, refugees, and so here is our opportunity to invest our own backyards directly to be able to help dismantle some of those systemic barriers by creating opportunities for employment or housing or otherwise access to services and opportunities to create assets for success. And that, I think the final reason of why is we have billions, if not trillions, that can be dedicated to tackle local challenges. And so if you think about, in Ontario, there's $3 trillion in assets. If we mobilize just 1.1% of this, we could move $30 billion in capital alongside good public policy, alongside philanthropy for place-based impact investing that tackled problems in our own backyards. Finally, I'll just say a few examples. So what does this look like? Anything from the Perro Center for Women's Enterprise in Thunder Bay, which operates lending circles that provide small loans to women-led and women-serving enterprises, or Verge Capital in Southwestern Ontario. It's a community loan fund, primarily provides capital for enterprises, organizations, and real estate projects in the Southwest. So investing in everything from Earmark or Yaya's Kitchen to Indwell, again, one of those other examples of affordable housing projects in London. Or there's organizations like Fair Finance Fund, Rise Capital, and others. Lots of great cases across Canada. And otherwise, it's very active and many activities going on in the U.S. as well. Anything from Benefit Chicago, which is a $100 million fund that's financing green energy projects, affordable housing projects in the region, or City Funds in Bristol in the UK, which is seeking to tackle some of the biggest social problems in deindustrialized areas and regions like Bristol in the UK, which is really vital to be able to create those economic assets and resilience for going forward. So hope that gives you a bit of a sense of what place-based impact investing is, what the features of it are, some of the rationale behind it, and some examples. And so we're looking forward to all your questions and the conversation today. Thank you.
Thank you, Adam. And we'll ask Mike to come on, please. Great. So lastly, we have Mike Thiessen, our Director of Sustainable Investments. And Mike is going to tell us about climate action impact investing. And we all understand why it's important to reduce our carbon footprint and to fight global warming when we can. And as a matter of fact, climate action is number 13 on the UN SDGs. So over to you, Mike.
Great, thanks, Sue. So I'm really excited to talk about climate action impact investing today. It's an area where there is so much innovation going on, so much talent moving into projects and startups that are focusing on climate action, and so much capital moving into the space as well. A lot of impact investors, including a lot of our clients. And I think one of the main reasons why so much resource is going towards climate action is just the sheer magnitude of the problem, of the issues going on. Right now, you know, we always hear about a lot of these stats, but just to reiterate, you know, temperatures around the world are rising, weather patterns are changing, more natural disasters, and a lot of these are affecting economies in the developing world, so poor areas of the world more than other areas of the world. And all of these issues are just going to continue to compound unless something is done. And so I think that's why a lot of people want to get into climate action. And I am quite optimistic, despite these issues and the big risks. I'm quite optimistic about climate change mitigation and what can be done. I think right now we're seeing trends around the world, especially macro trends, really pointing in the right direction. We have countries around the world making commitments to go net zero, or even beyond that in many cases. We have a lot of capital flowing into research and development for clean tech, for renewable energy. In the US, there may be a lot of additional capital moving into that space, into R&D, into renewable energy infrastructure, into research and development for electric vehicles, changing energy standards, renewable energy requirements, and things like that. And then the economics are really exciting too. So if you just look at solar, solar in many areas of the US is now the cheapest source of energy. So cheaper than natural gas, even without subsidies in many cases. And in 2021, it's predicted that solar is going to drop in cost by about 20%. So the cost keeps dropping. And many other technologies are also becoming more viable. Things like hydrogen is becoming more viable for more industries to use for energy. Carbon capture systems have technology that is advancing quite quickly, which is very exciting. And a lot of multinational corporations are starting to build partnerships with a lot of these projects, with a lot of these startups, which is very exciting, because we'll be able to see a lot of this technology really scale. And so for these reasons, a lot of capital, a lot of investors are moving into climate action, including a lot of our clients. So I think before I move on to some climate action impact examples, I think we have a poll. So if you want to go to the poll, there it is. So what area of climate action are you most excited about? So we have carbon capture systems, we have hydrogen, we have solar, we have electric vehicles, or we have other. And if you do choose other and you want to share with everybody what your other is, then put it in the chat. So it looks like interest is spread across a few of them here, which is great. Okay, so it's looking like solar, carbon capture systems, electric vehicles are kind of the core interest. And that's great. There's so many investments coming up in those areas, and all are greatly needed when it comes to climate action. Great, thanks for participating in the poll. So in terms of impact investing examples with climate action, there's kind of two bigger categories. I guess you can look at more public type investments, more liquid investments, and then you can look at more private investments, so more alternatives. And both can make a lot of impact. Both are quite exciting spaces to be in right now. In the public equity space, there are a lot of large corporations that are making big impact when it comes to climate action. And so we actually at Genis, we have a high impact equity fund that invests in a lot of these companies. So we're investing in companies like Ballard Power, like SMA Solar, like Vestas Wind Systems. Earlier this year, we were investing in Tesla, a lot of sustainable energy or sustainable building and sustainable materials companies, energy efficiency projects. So there are a lot of different stocks that focus on climate action. And also in the liquid space, there are green bonds. So green bonds are bonds where the proceeds are go towards green projects. So things like renewable energy, things like low carbon transportation, energy efficiency projects. And Genis is actually about to launch a global impact bond fund. So this is going to be launching kind of later this month or early in May. And it's going to really focus on green bonds. So that's an exciting place if you want more liquid investment that you can get in and out of quite quickly. And then in the private space or alternatives, we've been working with a lot of clients to build their portfolios in private investments. So there are many great private green bonds that you can get into that are helping to finance renewable energy projects around Canada. There are private equity investments, there are impactful real estate investments. There are a lot of venture capital investments that are coming up that are investing in startups, investing in great companies within Canada and beyond that are trying to build, breakthrough technologies that will really help with scalable decarbonization. And we've really found that has been a trend that a lot of investors have been moving towards, is focusing a lot on these bigger, scalable ideas. A few years ago, a lot of investors were more focused on incremental change when it came to climate action investments. So investing in renewable energy infrastructure or utilities, which does produce a lot of impact. But right now, we're seeing more investors deciding to move into areas where there's potential to make really scalable impact with a lot of these venture capital style clean tech investments. So a really exciting space. So climate action impact investing has been growing quite fast, and I think it's because of the sheer size of this issue that we're facing as a civilization. But I think through impact investing, we can really make a difference.
Thanks, Mike. Thank you to all three of our presenters for your great insight. I feel like we have a good primer now on all the three impact investing trends, and we're going to move to the QA now to dig a little bit deeper into these issues. And I noticed there hasn't been a lot of questions in the chat box, so everybody, if you have any questions, please enter them in the chat box for us. And I am going to, I believe I'm going to turn off my camera and bring the other 3 speakers back on to participate in the Q&A. So can okay, we're just waiting for Mike. Okay, great, thank you. So our question is a pretty common one, and it seems like a good place to start. So I think I'll start with Adam first. So Adam, your question, please. So Adam, this all sounds fantastic. It all sounds great, but I still need to fund my retirement. So am I giving up performance when I invest for impact?
It's a great question. So I think there's lots of ways to look at that. So one is generally the financial performance of impact investments overall in comparison to market benchmarks has been at or beyond the traditional or standard benchmark market rates. And so if you look at whether it's Morningstar or RIA, the stats have shown, particularly over the last 12 to 24 months, that the financial performance has been strong, if not improved in comparison to mainstream finance. I think the second is impact investments cut across all asset classes and risk profiles. And so there may be some cases where you would be comfortable with a lower rate of return based on an opportunity that you thought had a high impact. And so that's a choice that an investor would make, but it's something that you certainly can do. But I would say that if you're to look at the financial performance of be it place-based funds or climate action or early stage impact investments, you'd find many of them that would be at individual rates of return that you would find in more traditional products. So I think the case that may have been made previously that impact is a sacrifice for return, it doesn't bear itself out in the facts, but the condition that is, some folks may decide that for a variety of reasons that they're comfortable with a lower rate of return. So that would come to product availability and choice. Because if you're investing, say, for example, in an affordable housing project for Indigenous women, the upside on that is one almost entirely of impact with the potential for a more modest rate of return. So just making sure that that's a part of the economic mix that you'd have to think about as an investor. But just
Great.
One perspective.
Thanks for that, Adam. And what about you, Maury? How would you answer this question as it relates to early stage impact investing?
Well, through kind of our teaching and programs that we run, we talk a lot about this. So, we bring individuals across Canada together to educate on early stage impact investing and how you can get involved. And one of the first things we address is that scale of return and what that looks like for you. And, as many of us know, we have a diverse portfolio that we're investing in, right? And you might feel that, okay, maybe the first step in, at least for early stage impact investing, is diverting some funds that might be otherwise saved for philanthropic measures and putting it with some of these early stage companies where you have the opportunity to have large impact and arguably a bit more control in some situations with your capital and influence, at least, on these companies. But there is opportunity for a return. So, what we're seeing and the data that's coming out of these early stage impact businesses, so startups that are purpose-driven, they're offering similar, if not higher returns to angel investors. So that's what we're seeing on our end. And again, it's, a reflection. I think that there's, as Adam was speaking to, a lot of other values that can come out. And we, on that scale, it's like, okay, on the one hand, it might be more philanthropic. On the other hand, you want those traditional, private early stage returns with the 10x to kind of keep that portfolio growing. So, you can manage that. But there are a lot of other values that you're going to be getting out of early stage impact investing as well. So, you might not want to throw your entire retirement savings into early stage, because it is very high risk, early stage impact investing or early stage investing, period. But you are seeing excellent returns coming out of these companies and investments.
And Mike, what would you like to add?
I agree with what Adam and Marty said. I think there are a lot of studies, showing on the private side that impact investments have been making returns similar to benchmarks, similar to conventional investments in the same classes. And on the public side, there's not too many studies on how well public equity impact funds have done, but from just Genes's experience, we've had our public equity impact fund around for almost 7 years now, and it's in line with its benchmark, which is a conventional benchmark, the MSCI World benchmark, and it's making a lot of impact, whereas the benchmark isn't making much impact, if anything at all. So we are seeing that you can have the same returns and still make that additional impact.
Another question here. It's a pretty common question that we get. So it's to all three of you, and we'll start with Mari this time. And it's, how would you respond to the greenwashing critique? And is there a way to quantify and depict impact and success beyond the mere bottom line, so beyond just dollars?
Greenwashing isn't something we worry that much about in early stage impact investing, or at least from what I see, because, these are small companies, kind of, it starts with even just a few founders, or, up to kind of 50 employees or smaller. So, there's very, very clear mission and vision for this impact, and we also have kind of a set of, I know you spoke to Jen in the introduction, but a set of standards that we use as impact measurement for early stage businesses, and then as they grow, they can get many of them will get their B Corp certification, which is really a thorough report on their kind of sustainable approach to building their business. So it's not something we see that much in early stage, because you kind of, you really have to invest a lot and make that mission and vision for your company very clear that you are on that impact trajectory. We're trying to catch as many companies as we can early, because if you have it embedded into the base, the foundation of your business, as you grow, it's a lot easier to, implement it throughout the growth versus retrospectively. So, typically not an issue from my end.
Comments on greenwashing?
Did you say Mike?
Yes, sorry, Mike.
Okay, great. Yes, so greenwashing in the public equity space is a really big issue, especially in this last year. In 2020, suddenly sustainable investing was extremely popular, which is great, but it means that every bank and asset manager is throwing up an impact fund or a sustainable fund, and not all of them are the same. There is a lot of ETFs, a lot of funds out there that launched in 2020 or 2019 that have a lot of holdings in there that I would not say are impactful or green. There's even, we've looked into some, and there's, oil and gas companies in there, and other areas where you probably don't want to invest in if you're wanting a green fund. So it is an issue. I think one thing is to do kind of just a look at the holdings. I think that's kind of number one. Do these holdings align with my values, align with what I think I'm getting into? And if they don't, of course, then move on. Another thing is to ask about the carbon intensity or the carbon emissions of the fund, if you're wanting something that's more of a low carbon type fund. And so a lot of these funds will give you their carbon intensity, If they don't, then that's kind of a red flag there as well. And then if you are wanting something that has more climate action impact, I think that you can ask the fund manager about the environmental impact that it's making, and what impact measurement that they're doing to determine the impact. So there's a few different techniques, but definitely don't trust anything that says it's green.
Great, thanks, Mike. And Adam, do you have anything to add?
Yeah, it's a great question. I think, green paint might have been sold out at Home Hardware for the past 18 months, particularly in the public markets. But I think, a few thoughts. So one, looking at the investment opportunities, we look at impact in a number of different categories, and any investor can also apply this approach as well. So looking at the investments for the company or the manager, do they have an intention to do good? Are they setting themselves out to be able to have an impact, as opposed to create an interesting business opportunity that is just going to generate money? And so something like Lucky Iron Fish, which is set as a business to be able to create a medical device in the form of a fish that goes into a rice pot or a soup pot that is designed to reduce iron deficiency or anemia in the global south. That business has an intention to do good. It's trying to improve health. Second is, do they have measures? So do they report those measures of their impact on an ongoing basis? As Mike said, you can ask either the manager or the company for that data to be able to demonstrate that impact. Third is, do they apply a standard of impact? Again, it might be the company, the fund, or the manager. There's many standards out there in the public or private markets. On the private side, there's the B impact assessment or B Corporation standard, very commonly used by early stage but increasingly larger businesses as well. And I think the fourth is also around the alignment with the SDGs. And I'm not going to point Mike out, but I will. And that is, how do you organize the impact portfolio? And on the public side, you can look at the intensity of revenues from a public company in alignment with the Sustainable Development Goals, and then compare that with market benchmarks. And the same can be said for private companies or opportunities as well. How are they lining up with the goals that we're all seeking towards 2030? And I think maybe the final thing is just working with your manager or institution, advisor or otherwise, to ask them these questions. I think by the very nature of just asking, is it impact, may put them on their heels, because they may not be asked that question as people just rubber stamp and say, yes, it's got green, I'm going to go. So I think that you have the power as an investor to ask that, either to change what they're doing or for them to prove to you as a company or a manager that they are truly doing good.
Great, thanks, Adam. That's a great point. So the next question is probably going to be for Mike. What are your thoughts on the prospect of nuclear rising to prominence in the coming years? And are there any barriers?
I think there are a lot of barriers. I think that nuclear is something that I think will be quite important in the future. I know this is quite a controversial topic, so some people might agree or disagree on this, and that's okay. But I do think that most nuclear technology was created, in the 50s and the 60s or prior, and now there is so much new technology that hasn't been really applied to nuclear, because there hasn't been many, if any, large-scale nuclear power plants in North America. There may have been some, but there's not on the scale that there was in the 50s and 60s. But I think that it will be needed in order to make these goals. A lot of countries have, extremely ambitious goals of going net zero, and even the US is wanting to go, no all carbon pollution free power by 2035. So that's 14 years from now. So there's going to have to be some big moves made. I think the barriers for nuclear are going to be, they have to prove that they can do this in a way that will be environmentally friendly, because there are so many people and groups that really won't accept nuclear if it's not going to be environmentally friendly. And I think regulators are going to be a big hurdle to get over. I think it's a really capital intensive area to generate power, so that's going to be a big hurdle. So there's a lot of these big hurdles, but I do think that we have the technology, that can make it a lot safer than it was before, more environmentally friendly. Yeah, we do have the need with all of these targets. But I'm sure there's varying opinions there.
Great, thanks. And Adam or Maury, do you have anything to add to that? Okay, great. Sorry, Adam, your audio was off there for a second.
I wouldn't have anything to add.
Okay, great. We'll move on to the next question. And there's a lot of questions around measuring impact. And I know we've already touched on the topic a little bit, but can you three please speak? And we'll start with Maury on this one about how to measure the impact of our investments.
Yeah, definitely. Thank you. And, again, I'll speak to the early stage investing. So really, in that early stage space, you would see yourself either as an angel investor or, perhaps investing through a fund. There's lots of great funds across Canada, in particular, active impact investments. I believe some people from Rise are here. So there are many ways to go about that. And, as you're kind of taking that approach, there are quite a few tools out there that can help support you measure what that impact is in the business and ensure that companies are the companies that you're investing in are hitting those targets just as much as they would be promising to hit or anticipating to hit their financial returns. And those really are built in. I'd be happy to share actually, or perhaps Keith can share some of the tools that we use to measure impact, or we guide investors to use to measure impact in that early stage. As a company, and Jin has, some great guidelines around that as well. And then we also talk a lot in early stage investing about impact adjusted returns. So, if you're hitting certain impact, whether it be employment or whether it be, garbage reduction or whatever that impact metric is or the target is for that particular company, by hitting those kind of impact returns, sometimes there are negotiations where you actually have adjusted financial returns. So to really motivate those founders and those companies to be hitting those impact targets. So there's lots of tools that we use in the early stage to kind of set those targets for the companies just as much as any financial return target is going to be, and have those kind of quarterly reports and updates. And as the companies get bigger, they can go into more formal systems, which I believe Adam and Mike will speak to.
Okay, great. Thanks, Maury. So we're really limited in time here. We got a couple of minutes left in the Q&A, so I will throw it over to Adam and Mike. If you could quickly come up with your answers, please, that'd be great. Thank you. Adam?
The impact management project would be a great resource, and I'm happy to share that following. There's a common approach to impact measurement as well for practitioners. So there's systems that you can adopt to be able to help with your impact measurement. I think in addition to that, other tools are, I have talked to like the B impact assessment, the organization around impact according to the Sustainable Development Goals, I think is a really helpful and handy tool. Generally, I would say it is, again, finding the right opportunity and the manager who would be able to apply the approach and then provide you with that data and framework to be able to assist so you can get those reports on an ongoing basis, which is super helpful. But happy to share any other resources following this conversation.
Great, thanks, Adam. And Mike?
Yeah, for impact measurement, we primarily use a net impact score that we've created. So so we're looking at the positive impact and negative impact of investments. So we actually do this not only for impact investments, but for other investments as well, because we think that all investments are making an impact. You're either making a positive impact, a negative impact, or something a bit of both, and it could be large, could be small. So we're wanting to measure the impact of all our investments, and the way that we do this is look at the percentage of revenue that a company is generating for products or services, that have a positive impact, that are contributing towards a sustainable development goal. And then on the negative side, we also do that, but we look at products or services that are contributing or that are detracting from sustainable development goals. And then we have a net impact from there. And so that's kind of our kind of more easy to understand, but still meaningful impact measurement tool that we have in all our client reporting as well. And then from there, we can add on other frameworks if clients want to measure different outputs for their investments, or maybe they want different frameworks such that Adam and Mari were talking about as well.
Great, thank you. So we'll have to end the QA session here. Thanks to everybody who submitted their questions. So we're a bit overwhelmed. There's so many of them. And as I mentioned, if your question wasn't answered today, we're going to try our best to get an answer for you and to follow up in the coming days. Now I'd like to wrap up with some closing thoughts from our expert panelists. So we'll start with Mari.
Speak to them, so hopefully we can connect on LinkedIn as we go. I think that a slide is going to be pulled up, so I'll just speak to this. If you're at all interested in early stage impact investing, we would absolutely love to connect with you, have a coffee, explain more about the work that Spring is doing, not only here in Canada, but globally, and how you can get involved. To those kind of impact investor training programs that we create, we call them, or that we run, we call them the Impact Investor Challenges. There are some opportunities for you to get involved. We have on April 20th, which is next Tuesday, we have a pitch night. So you'll see 20 early stage impact companies pitch to our investor cohort of 20 new impact investors. On the 21st, the day after, we have our sister program running in Campbell River. We have the pitch night there. You'll see, a lot of really, really exciting emerging technology companies that are in the impact space pitch. We also have the finales of these programs, so where the investor cohort will actually choose which company they'll invest in for the $100,000 on June 16th and 17th, respectively. And then this fall, if you are located in Vancouver, which I believe many people are, we would love to invite you to join or learn more about how you can get involved as an early stage impact investor. We're kicking off another program here out of Vancouver, and yeah, would love to tell you more about that. Otherwise, thank you so much for your questions. As I said, Spring exists to change the world through entrepreneurship. So everything that we do is really supporting those early stage companies be successful for, further down the line, and kind of, create excellent policy that are going to have long lasting effects on our globe. So yeah, would love to connect. Thank you so much. And leave over to Adam now.
First up, thanks so much to Janice for organizing this particular event, in terms of gathering such a good group of participants and panelists, Sume for facilitating, and to the other panelists for being really awesome people. And thanks as well to the participants for all their questions. Just want to say one final thing, two things. One, if you're interested in finding out more, I know our information will be provided a little bit later, so happy to answer any follow-up questions. This is really a sample about what investing is all about and getting some really interesting topics. If you're an impact investor or asset owner, we are organizing an initiative called Impact United. And so it's a broad-based community and movement of individual investors, families, foundations, faith-based organizations across Canada. And they're seeking to be able to move their investment capital towards social, economic, and environmental justice. And the idea is, how can we connect those asset owners, help them share, learn, and collaborate with one another. So we've got a launch event coming up on Thursday, April 29th. If you're interested in finding out more, please email me. And otherwise, as I said, if you have questions, happy to chat. But thanks again, and I'll pass it on to Mike.
Great. Thanks everybody for attending today. It was really fun to talk about impact investing. And I think one note that I just want to say is, I know at the beginning a lot of people in the polls were saying that they're new to impact investing and it's something they want to learn more about. I would just encourage you to continue to ask questions, continue to read. We can send you a lot of resources from Genis, and I'm sure Spring and SPX have resources as well. And certainly continue to ask questions and learn more. So we have a webinar that's coming up in May. I actually have something that's blocking the date here, so I can't exactly see the date. There we go, May 20th. I see it. So it's a webinar on hydrogen and hydrogen's role in the low carbon transition. And we have an expert, Chris Reed, that's going to be talking to us about hydrogen. So certainly attend if this is something of interest. We would love to have you there, and definitely reach out if you have any more questions. I think my LinkedIn details were in the chat. So that'd be great to connect and talk more and answer more questions. Thanks.
Thanks, Mike, and to all expert panelists. So I'm curious, now that you've heard all our experts speak about these 3 key 2021 trends, what do you think is going to be the most important one? So we have our last poll, which hopefully will show up, and there it is. So the question is, what do you consider to be the most important trend in impact investing in Canada? And you see the answers there: climate action, place-based impact investing, and early stage impact investing. And climate action is the front runner so far at over 70%. So we'll just wait for a few more answers to come in. And it looks like climate action is number 1, followed by place-based impact investing, and with early stage impact investing, that's the 3rd choice there. Great. Thank you, everyone, for participating. So thanks again to our panelists for taking the time to be here and for sharing your insights. It's exciting to know that impact investing options are growing and impact investors have more and more choices available to them. To our audience, please stick around, because as soon as we end here, you're going to be redirected to a survey, and we'd love to know your thoughts and feedback on how we did in today's session. So again, thank you everybody for joining us, and have a great day.